Assalamualaikum warahmatullahi taala wabarakatuh. I'm Puan Marshita Hashim from Faculty of Accountancy UiTM. Now I would like to explain about basic accounting concept or principles. But before we look at basic accounting concept or principles, it is good for us to understand the accounting cycle first. So after completing this topic, you should be able to understand the accounting cycle, and then you should be able to understand the accounting concept or principles. Alright, this is the accounting cycle. Accounting cycles is actually the process of recording and processing of all financial transactions of a company. The main duty of bookkeeper is to keep track of the full cycle from start to finish. The cycle repeats itself every year as long as the company remains in the business. Okay, the first step is business. The first cycle is actually business transactions. Okay, this is where the financial transactions start the process. If there were no financial transactions, there would be nothing to keep track of. Transactions may include a debt payoff, any purchases or acquisitions of assets, sales revenue, or any expenses incurred. The second step is journalizing. So with the transaction set in place, the next step is to record these entries in the company's journal in chronological order. In debiting one or more accounts and crediting one or more accounts, the debits and credits must always balance. After this process complete, we can post all the entries to the ledger. The ledger will show summary of all transactions to include into individual accounts. Okay, and then from journal we post to ledger, and then at the end of the accounting period, which may be quarterly, monthly or yearly depending on the company, a total balance is calculated for the accounts. Okay, and then we will prepare the trial balance. Finally, the statement of this financial statements or statement of profit or loss and statement of financial positions will be prepared. Okay, now let's move to basic accounting concepts or principles. Accounting concepts refers to the basic rules, assumptions, and conditions that defines the parameters and constraints within which accounting operates. In other words, accounting concepts are generally accepted accounting principles which form the fundamental basis of consistently preparing the universal form of financial statements. This is basic accounting concepts that business need to understand before we can prepare financial statement. Alright, duality concept. The first one is a duality concept. So this concept refers to double entry system, which is the debit side and credit side of accounts. In other words, each transaction must be recorded in both sides of accounts. Debit is the portions of transaction that accounts for the increase in asset and expenses and decrease in liabilities, equity, and income. Credit is the portions of transaction that accounts for increase in income, liability, and equity, and the decrease in asset and expenses. The classifications of debit and credit effects is structured in such a way that for each debit there is a corresponding credit and vice versa. Hence, every transaction will have dual effects, that is the debit effect and credit effects. The applications of duality principle therefore ensure that all aspects of transactions are accounted for in the financial statements. Okay, the second concept is business entity, or sometimes it is known as entity concept. The business entity concept assumes that the business and the owner are two separate entities. Therefore, the transactions associated with a business must be separately recorded from those of its owners or other business. Here, the use of separate accounting record is required for the organizations. This concept is important to separately track tax, financial performance, and financial positions for each entity. The third concept is going concern. Okay, under this concept, we assume that the business entity will continue its operations in the future and will not liquidate or be forced to discontinue operation due to any reason. A company is a going concern if no evidence is available to believe that it will or will have to cease its operations in foreseeable future. Okay, next regarding money measurement. Under this concept, only transactions with monetary value can be recorded into accounts. For example, sales may be increased due to loyalty of customer towards our products, but in this case, customer loyalty cannot be recorded into accounts because there is no monetary value on customers' loyalty. But if sales is increased by 10,000 ringgit, for example, per month due to customer loyalty, then we can record the sales transactions in the books. Okay, next regarding consistency concept. The concept of consistency means that accounting methods once adopted must be applied consistently in the future. Also, same methods and techniques must be used for similar situations. It implies that a business must refrain from changing its accounting policy unless on reasonable grounds. This principle helps in preparing consistent and uniform accounting records. It avoids accounting manipulation tricks used by accountants to present unrealistic and favorable financial statements. This principle also offers great control over assets valuation methods such as treating inventory and depreciation of assets. For example, there are few methods in order to depreciate non-current assets, such as reducing balance method and straight line methods. If the business chooses a straight line method on the first year, therefore in the future year onwards, the business must continue using straight line method. Okay, the next step is periodicity concept. The periodicity concept is also called the concept of a specific accounting period. As per the ongoing concern, as an unspecified life of the entity is assumed. For a business entity, it causes inconvenience to measure performance achieved by the entity in the normal course of business. This concept is used to prepare and present financial statement into the artificial period of times required by internal management, shareholders, or investors. What does an artificial period means? Well, most of the financial statements are prepared based on fiscal years. Okay, the last one is accruals or matching concept. Matching principle and accrual principle are some of the most fundamental accounting principles. Matching concept states that a company must record its expenses only in the period when the revenues associated with the expenses were earned. On the other hand, the principles of accrual accounting requires revenue to be recognized only when it has earned and record expenses when it has incurred. Okay, that's all the explanations for these topics. Now, in order to make sure that everyone understand what I have explained just now, you can try exercises. Few exercises that I have prepared for you. Thank you. Bye-bye.